All right, people should be able to start joining. We'll give it 1 minute and then go ahead and get started. All right, I see him filling in now. All right, great. There they are. Give it 1 more second, and then we'll get started. All right, I'm sure people will continue filling in over the next few minutes or so, but I want to go ahead and welcome everyone. Good afternoon, and thank you for joining our Q3 financial market and portfolio update. We appreciate you taking the time out of your day to hear from us. So please feel free to ask questions throughout, and Steve and I will both monitor the chat and Q&A, and we'll either get to them during or at the end of the presentation. So I know Steve has a lot of good topics to cover today, as always. So with that, I will hand it over to Steve.
Thank you very much, Katie. And thank you all for joining us. This is our quarterly portfolio and markets update. We did switch the time to lunchtime. I'm hoping that everyone is able to enjoy a tasty lunch, perhaps, as I go through what I hope is some interesting and informative and hopefully some humorous facts about what's going on in the markets. And as always, please make sure to send us your feedback. We always want to know what you want to hear about. So just to get our disclosures out of the way, what are we going to be covering today? Well, one thing that we do want to highlight, and there's been a lot of talk about, is a lot of the hype around artificial intelligence or AI. So I will address that as part of the markets update. And then we'll also talk about what we're doing in the portfolios as a result of the current market dynamics. So what are some of the headlines we've been seeing out there? Obviously, inflation is still an issue, right? So this is a recent headline in Barron's of last week about inflation. Recently, we actually had a very good inflation number, meaning the number was down, meaning inflation was coming down. Now, one thing sometimes that I think people misinterpret about inflation being down, that actually doesn't mean that prices are coming down. It actually just means that the rate of inflation is coming down. Once prices have gone up, they rarely go down. So the pain, a lot of the pain that people feel in the supermarket buying bread or cereal or whatever it may be, you know, those prices unfortunately aren't really going to come down. Really, what we're going to hope for is that they really don't go up much moving forward. But we'll talk more about inflation in a minute. This is a recent headline from Bloomberg about the US dollar. The dollar has been weak in the last few months against most other currencies. That does bode well for international stocks, which we've always talked a lot about. So this is sort of a headline talking about that. I'm not so sure that that's necessarily true, but you know, headlines are what grabs people's attention. And of course, we mentioned this before, we do need to talk about artificial intelligence. You know, this is a recent article from the Journal about the artificial intelligence boom. It has arrived. And are we ready for it? And then finally, a lot of talk about the fabled soft landing. What is a soft landing? Well, a soft landing means that the Federal Reserve Bank of the United States, or the Fed, is able to actually reduce inflation and slow the economy down without breaking something or causing a recession. A hard landing would be if actually the Fed does manage to slow the economy down and also ideally vanquish inflation, but it also will probably cause a recession. So a soft landing is somehow the Fed manages to get rid of our inflation problem without breaking anything or causing a recession. And they've never really ever done that. Although apparently a lot of people think they might be able to this time or are on the way to doing that. So we'll talk a little bit more about that. So what's been happening really in the first half of this year? You know, the first half of this year was really pretty strong. We obviously had a pretty poor year in 2022 in the markets. And as usual, markets tend to change course. After a bad year, a large majority of the time you tend to have a better year, and that certainly has proven to be the case so far. We didn't have an issue with the debt ceiling. Inflation did start to come down pretty quickly in the first half of this year. Interest rates likely peaked in the first half of this in the first half of this year. We got through what potentially could have been a nasty banking crisis. We only had a few bank failures, and they occurred because the Fed raised interest rates so fast in such a short period of time. And that did cause a lot of stress in the banking sector, and a couple of banks didn't make it. But it was relatively contained. It didn't really spread. We didn't see widespread banking panic or bank failures. And so the market was pretty excited about that. The S&P basically did enter a bull market being defined as a 20% rise from its low. And of course, everyone started to think, maybe the Federal Reserve is really got it this time. Maybe they're really going to manage to slow things down and kill this inflation problem, and we won't have to worry about a recession. What do we think is going to happen in the next half? In other words, this quarter and the next quarter? Well, I think it's going to be a lot harder to enjoy better equity returns. I think it would actually be somewhat of a victory if we held on to most of the returns that we've achieved so far this year. And we've talked a lot about this, but unemployment has been bouncing around at record low levels now for quite some time. And inevitably, it's not going to stay that way. Inevitably, unemployment is going to start to rise. And we are seeing some weakness. There have been some layoffs in various sectors. And obviously, there's some strange things that we haven't seen in almost a century in regards to coming off a insanely high unemployment rate during the pandemic. And we're still experiencing sort of the bounce back from that, where it's, employers can't hire enough. And that's especially true in the service sector, travel, leisure, entertainment. They are still hiring very, very aggressively and are having a difficult time finding people for those positions. So I do think the second half is going to be a little bit more of tough sledding. And then, what does that mean in 2024? Well, hopefully in 2024, a lot of the dislocations we saw as a result of the pandemic in terms of supply chain slowdowns, some of this weird activity we're seeing in the labor market, that's probably going to get a little more normal. Hopefully the economy if it does enter a recession in 2024, which is now what most people are predicting, and that's what the yield curve is predicting, and we'll talk about that in a minute, that it won't really be that bad. As a matter of fact, maybe it'll be a really short, shallow one. And ideally in 2024, if we do enter a mild recession, what is the Fed going to have to do? They're going to have to cut rates, right? And when the Fed cuts rates, the market always loves that because the cost of capital goes down. And when the cost of capital goes down, people feel a lot better about investing their money in more risky things, stocks in particular. So if we look at this quarter by quarter, and this kind of goes through in a little more detail what we saw, April was kind of in the last quarter. April was, cautious optimism. We didn't have a bank problem. We did have sort of a hiccup in terms of the political wrangling over the debt ceiling. I know, we did speak to a lot of clients who were very nervous about their assets because they said, "Oh my goodness, are we going to, end up defaulting on our debt, and that's going to send the markets into a tailspin?" That didn't happen, even though that was, a potential threat of happening. Ultimately, that was resolved, and that they kind of kicked the can down the road on that. And so the relief was felt in June, where people felt like, wow, a lot of these negatives are behind us. And actually in July, after we've seen a great rally in June, July has been the same. We've actually basically had about, I want to say 12 plus consecutive days of the S&P going up. And a lot of that has to do with the fact that a lot of the things that people were worried about happening this year have not come to pass. And people are excited about the fact that inflation really seems to be on its way down. So now what the Federal Reserve is really focused on is the labor market, because as I've always mentioned before, it's really, really difficult to get rid of an inflation problem when you have super low unemployment. And why is that? Well, that's because when you have low unemployment, the people who do have jobs tend to ask for more money. And the people who are looking for jobs have more bargaining power and tend to get paid more when they do get those jobs. So that causes wage inflation. And wages, when you have higher wages, what does that mean? Well, that means you can afford to pay more for things that you need to buy, whether it be cars or food or going out and having fun or travel. And so that actually causes inflation to stick around, right? Because even though prices are high, people are still paying them because they're getting paid more. So the Fed kind of knows that if you really want to get rid of inflation, you have to get rid of wage inflation. And it's almost impossible to get rid of wage inflation when you have a really, really strong labor market. So that I think the Fed is going to be paying very close attention to the rate in which we are adding jobs, the rate in which wages keep going up, and ultimately the unemployment rate. So that is something to keep an eye on, because I do think that once that unemployment rate starts moving up, like we said, it's kind of like a freight train. It doesn't stop. When the inflation, when unemployment starts moving up, it usually keeps moving up for a long time, and by at least 2%, which would mean it would come from around 3.5, 3.6% where it is today to upwards of 5.5%. And obviously that would not necessarily be good for markets. That would mean there is stress and potentially we're in a recession. So let's talk about the bond market, because for many of you who have a good portion of your assets in bonds or fixed income, it's kind of interesting to know, how these dynamics have played out over the last couple of years. So 2 years ago, if you were in short-term debt, and this shows 1-month treasury bills all the way out to 30-year treasury bonds, and the interest rate is on the left-hand margin here. Well, this kind of shows that 2 years ago, if you were in short-term debt, you were essentially getting nothing. You were lucky to get maybe 1/10 of 1%. Even if you bought a 10-year bond 2 years ago, you were getting less than 1.4%. I mean, at the time, a lot of our counsel to clients was, why would you loan the government money for 10 years and only accept a 1.4% return? Not great. And that was one of the reasons why people really piled into stocks 2 years ago, because there was really nowhere else to earn a decent return on your savings. So then 1 year ago, what happened? Well, we started to see things change a bit. So you'll notice that if you were invested in short-term securities last year, that was a little better, right? You could invest in a 1-year treasury bill and earn over 3%. That was a heck of a lot better than 1/10 of 1%. The 10-year, instead of earning less than 1.5, now you almost earned 3% on the 10-year. So if you loan the government money for 10 years, at least they would pay you 3% a year. Still not great, but a heck of a lot better than 1.4%. And where are we today? This is the inversion that you probably have always heard people talk about. What's going on in the bond market today is an inverted yield curve. Inversion means that short rates are higher than long rates. And, why would that ever happen? Why would I ever accept why would I ever give the government money for 10 years and earn only, this chart is telling me, about 3.8%, versus I could buy a 1-year T-bill and earn off almost 5.5%? Well, that's because people expect this to normalize and get back to what it looked like a couple of years ago, where low rates are the shorter rates are lower than the higher rates. And why do people expect this to change? Well, that's because if we have a recession, which people expect us to have, at least within it, probably during 2024 at this point, well, what is the Federal Reserve going to have to do? They are going to have to lower these short-term rates. And that means ultimately cutting them, usually a lot more, depending on what the recession is like, it will probably end up making this curve get more normal. So a lot of people ask, well, still, if the rates are like this today, why would I ever buy a longer term bond? And really the answer is, well, you could buy 6-month T-bills today and 1-year treasury bills today, and that's fine. But if next year this curve is very different and back to more normal upward sloping curve, well, then what are you going to do when those bonds mature? Then you're going to either be forced to buy at much lower rates on the short end, or you would have wished that, oh, maybe if I bought a 5-year bond at 4%, I'd be pretty happy, right? So, and by the way, a 5-year bond for a government bond at 4% means that an equivalent corporate bond at that maturity would probably be yielding a little more. So you could probably buy a high quality corporate bond at a 5-year maturity, which would probably be closer to 4.5%. So something to keep in mind, and that's why a lot of times we counsel a laddering of bond maturities, meaning, yes, enjoy the high short end while we can, but at the same time, it also makes sense to have maturities of 2, 3, 4, even out to 5 or 6 years to make sure that you're not subject to too much reinvestment risk when this yield curve ultimately changes and becomes more normal. So now let's shift to the equity markets and, really what's been going on, what's been driving the rally in the equity markets? Well, quite frankly, the rally has been driven by a very small number of stocks. So if we just focus on the middle chart here, what's really fascinating is that almost 80% of the market returns this year, and this is the S&P 500 as the market, was generated by just 10 stocks. And you might ask, what are those 10 stocks? And they're kind of down here in the fine print: Alphabet or Google, Amazon, Apple, Broadcom, which is a chip maker, Eli Lilly, Big Pharma, Meta, which is Facebook, Microsoft, NVIDIA. What does NVIDIA do? They make really fast chips that are used for artificial intelligence. Salesforce, another .com company, and Tesla. Those are the 10 stocks that have really driven the market's return. And so kind of the phrase that people throw around today are saying that's bad breadth. Breadth as in B-R-E-A-D-T-H. Not bad breath, but bad breadth. And that's because we haven't seen the rest of the market enjoy that type of rally. So really, that's kind of sometimes a troubling sign, or it might mean that the market will broaden out. So really, from here, two things can probably happen. One is that other stocks will start to catch up a bit to those 10 in terms of returns, or those 10 will start to come back down to earth and act a lot more like the other 490 stocks in the S&P. So let's talk a little bit more about what that means. And by the way, a lot of people ask, what are the largest companies out there in the stock market? So we're borrowing from the Value Line database right now, but what you're looking at right now, these are currently the 10 largest stocks in the world. And so you have Apple, which now has over a $3 trillion market cap, and Apple was one of the only companies ever to reach that lofty goal of being over $3 trillion. Microsoft not too far behind at $2.5 trillion. And then you have Google, Amazon, NVIDIA, and on down. Now, the one thing to keep in mind is that Alphabet is actually not considered a technology stock. Believe it or not, that is considered a communication services stock. Why? Because a large majority of Google's revenue comes from YouTube. So that's why Alphabet is considered communication services. Amazon is actually not even considered a tech stock. Why? Well, it's considered a consumer cyclical stock. Because of the e-commerce platform that it runs, it actually acts and gets more of its revenue from that business than it does from all its technology businesses, although that's actually changing as we speak. So these are the top 10. You might ask, well, what are the next 30? Or what make up the next 30? So here are the next 20 after those top 10. And as you can see, not as much tech, not as much communication services, actually more healthcare, more big oil, and more big financial services companies or big banks. So that is what rounds out the next 20 largest stocks. And so here are the top 30 in all their glory. Now, the other thing to keep in mind is, well, look at the price earning ratios of these top 10. I mean, the only bargain, and actually there are no bargains, because as we'll see in a minute, the average PE of the market right now is hovering right around 19 or 20. And the long run PE of the last 25 years of the market is closer to 16 or 17. So that means all these top 10 stocks have a PE ratio that's higher than average. You'd have to dig into the next 20 to get some bargains. And where are you going to find some bargains? Energy, financials, and healthcare. Those are some of the more unloved sectors right now because, as we've been talking about, everyone's been more excited about tech. And a lot of that is because of AI, or artificial intelligence. So I wanted to talk a little bit about one of the portfolio holdings that we have that's very much related to technology, which you may notice, and you may have seen it advertised on television. What is the QQQ? That is actually the ETF symbol for the Invesco QQQ, which is really an exchange traded fund that mimics the performance of the NASDAQ 100 index. And what is the NASDAQ 100 index? Similar to the S&P, but only 100 stocks. It has 100 names in it, but most of those names are tech oriented. So that's why this is considered more of a tech oriented index, and it performs a lot more like a tech stock itself, because most of the holdings in the NASDAQ 100 are tech oriented. So you might be, for those of you who really look closely at your portfolios, and I know many of you do because I spend many hours talking to you about it, you might say, but wait a minute, I actually have something that's similar to that in my portfolio, but it has a different name. So we'll talk about that and why that is. So this is actually, and I'm pulling up every, we use Morningstar Advisor Workstation to get a lot of data on these funds and ETFs. And so you'll see this is the QQQ is a 5-star rated ETF. And here are the top 10 holdings of the QQQ. And like I said, you'll see that most of these are technology or consumer or communication services oriented. Pepsi actually snuck in there as one of the top holdings as a consumer defensive stock. So it's not all tech, as I was saying. So this is what the QQQ holds. But you might say, but wait a minute, in my portfolio, I own QQQM. And you'd be right. What is the difference? Well, actually, there really isn't much of a difference. The QQQM looks almost exactly the same. These are the top 10 holdings of the QQQM. You might say, well, Steve, why do I have the QQQM instead of the QQQ? And that's because we believe that every basis point matters in the way we pick investments. So if we dig into what the expense ratio is of the QQQ trust, you can see right here where it's 20 basis points, or what is that? 1/5 of 1%. And that's the money that Invesco requires to actually run and operate that particular exchange traded fund. So why do we use the QQM? Simple. Look at the expense ratio of the QQQM. It's only 15 basis points, or basically almost 1/7 of 1%. So if I can get the exact same product with the exact same performance, but save 25% on that underlying expense of that ETF, I'm going to do that. So I actually, because we have good relationships with a lot of the money managers we work with, Invesco being one of them, we made that switch to the QQQM, more than a year ago, because we knew that that was a new version of the product that came out with a lower expense ratio. And and we felt that we should immediately be using the product that has a lower expense ratio. So that's one of the reasons why we pay careful attention to the products we use. And we're always making sure we're using the most efficient possible product for the purpose it's going to achieve. So I just wanted to point that out because I do think it's an important difference. I don't think every other money manager or wealth manager out there pays as much attention to that as we do. Okay, so let's pivot now to talk a little bit about this AI hype. So I'm going to borrow a little bit from Goldman Sachs research, because of course, when there's a big trend happening in the market, Goldman Sachs is going to write about it. So they recently put out a huge piece on AI, or more specifically, what's known as generative AI. And the point of the article was, is this a lot of hype, or is this really a game changer for the market and stocks in particular? So let's dig into that a bit. So first of all, what is AI, or artificial intelligence? So I have a few bullet points up here, but the bottom line is AI is developing neural networks that are able to analyze vast amounts of data in incredibly short periods of time. And only recently has the computing power been available to really make this powerful. And it actually, AI has been around for a long time, but it's really the evolution of computing power that has allowed AI to be able to not only go through, but also organize and make sense of the trillions and trillions of terabytes that are out there of data that are available to be analyzed on everything under the sun. And so why does this really matter? Well, it really matters because using AI, companies that use AI are probably ultimately going to become a lot more efficient. And if that means that they are going to improve profit margins or revenues or both, you need to know that, because that means that we're going to see a big bump in their earnings over the next several years. So that's why the market is kind of is excited about AI or any stock that's related to AI, because they're saying, well, if their earnings are going to improve as a result of using AI, I want to capitalize on that trend, right? And by the way, that's one of the reasons that we do have the QQQM in many of your portfolios, because we want to make sure that we're exposed to this trend as well. And talking about the trend, this kind of chart on the right this trend is for real. This is over really just less than a year. The Google activity on generative AI is seen in incredible growth. So this has really happened. Now, I'm not sure if any one of you have actually used the new Bing search engine, but that's actually one of the reasons why, I don't know if you remember in the previous slide, we saw that Google's price to earnings ratio was actually not as high as some of those other stocks. And why? Because now everyone thinks, wow, Microsoft is using AI better than anyone else. And they're incorporating that into their Bing search engine, which, by the way, I never used to use Bing, but I use Bing now. Why do I use Bing? Because it's using a more powerful AI functionality right now than Google. Apple actually came out with an announcement yesterday that they're now going to incorporate AI into the way they do things. So it's kind of funny the way everyone jumps onto these bandwagons. And so let's just take a step back. And I think this is a fascinating thing to think about for the future of not just your own career, but potentially your children's career. And so there was a researcher in AI. He had a team of researchers who looked into AI back in the mid to late 80s. His name was Hans Moravec, and there's a picture of lovely Hans in his youth. And what did Hans Moravec come up with? Well, he developed what's known as the Moravec paradox. And the reason he was looking into this is because this is right when IBM was developing its AI, or Deep Blue computer, which at the time revolutionized the thinking about AI because it was able to beat the grandmasters in chess. So IBM actually was able to leverage AI so that it could beat a chess master in chess. And so what Hans Moravec was really thinking about was, what does this mean for society? And the paradox that he came up with was that it's actually really easy for human beings to program AI to do what is really hard for us to do. But the paradox is that it's actually really hard for us to program computers to do what's really easy for us to do. And so that's the paradox. So what does that mean? Well, for example, AI can do things that I could only dream of doing. AI can translate and speak 10 different languages in a split second. I could never do that. AI can read through a 1,000-page legal brief and point out key terms and find out key phrases that would take me hours and hours to do. But ask AI to tie a tie, or button a button, or express an emotion, or advocate for a certain point of view. Easy for us, not so easy for AI to do. And so kind of the reason why I think Moravec's paradox is really interesting is because it does have an impact, I think, on what that might mean for the future of work and jobs. And I do think that because AI is so good at doing what I would call higher order brain functionality that a lot of white collar workers do today, whether that be lawyers or accountants, even doctors and financial advisors, AI is going to be able to do a lot of that work, which will A, maybe replace some of those workers, but B, also maybe make them a lot more productive. So it is something to think about in terms of the impact that AI will have, and why I think that paradox is very interesting. So, by the way, what's one of the manifestations of AI? You can actually download this on your phone today if you want. ChatGPT is basically an app that you can use on your computer or your phone. And by the way, it's actually the fastest growing app ever, as evidenced by the bar chart on the left. And that is actually the app that allows you to just type in anything, any question, any query, and get a very, very good answer. a lot better than the standard Google search. I will tell you that. And so it's basically one of the fastest growing apps. I don't think that's going to change. And so why are companies, and obviously that's why companies are jumping on the bandwagon here. And so this is kind of showing the number of times that S&P 500 companies mention AI or generative AI on their earnings call, and that's increasing dramatically. Everyone wants to say, and it doesn't matter whether you're a beverage company or a manufacturer or a tech company, you are going to talk about how AI is going to improve the way you do business. And that's why we're seeing a lot of hype around AI. So what's an example of how that may work? Well, healthcare, for example. I mean, I have a friend who's a radiologist, and he actually tells me that now AI can potentially read screens, radiology scans better than humans and find errors quicker than humans. Education. Imagine having AI being able to dynamically adjust what kids are being taught based upon their responses and their learning levels, like instantaneously to adjust a curriculum or the way something is being taught. Entertainment. You know, as everyone has probably been reading, there's a big Hollywood writers and actors strike right now. Well, you know, I would argue that very soon AI, and actually even right now, AI can probably produce a pretty good screenplay, which is almost as good as the real thing. So I hope those Hollywood writers have a good backup plan, because AI is coming. And so it is something to think about in terms of both the harmful yet also helpful impact AI can have on various businesses and various industries. So, you know, I think this is something really to keep an eye on, and certainly something we're keeping an eye on in terms of the investment potential. Now, I mentioned ChatGPT. Now, for any of you who haven't actually used ChatGPT, I do think it's pretty fascinating, so I encourage you to try it. So I thought I'd put a real life example. So I actually pulled up ChatGPT on my computer, and I was playing around with it, and I typed in a query that I thought it would fail miserably on. So for any of you who have ever spent time with me in terms of leisure time, I do have a somewhat of a weakness for really good tequila. That's one of my vices. I do appreciate fine tequila. I consider myself somewhat of a tequila connoisseur. I run tequila tastings all the time, and I've been trying to curate a really good tequila collection for many years. So I kind of think I know what I'm talking about when it comes to tequila. So I figured I'd ask ChatGPT, hey, ChatGPT, can you tell me what are the best tequilas that nobody knows about? Thinking that I would get a really lousy answer. And I'm sorry that the print is a little small here, but to be honest with you, the answer blew me away. It was well thought out, and of the top 5 tequilas that ChatGPT spat out at me, and I just ran this 2 days ago. Well, I actually own the number 1, 2, and 4. And here was, I thought that I really knew what I was talking about, and it took me years to figure out what I thought were really rare, fine tequilas. And ChatGPT figured that out in 3 seconds. So that's what I mean about the power of AI. It's really quite incredible. And in case anyone was wondering, this is actually a picture of the agave fields where tequila, tequila comes from the agave plant. And just for proof in the pudding, I don't know if you recall, but the number 1 was G4, number 2 was Fortaleza, and number 4 was Ocho. So these are actually bottles from my collection that I do have, but I couldn't believe that ChatGPT identified what I thought were very rare, very hard to find tequilas that no one knew about, and ChatGPT got it like that. So anyway, enough about AI. I do think it's a fascinating topic, but now let's talk about, as everyone always asks, hey, is the market expensive or not? Is this a good time to invest or not? Should we be worried or not? Well, let's look at what the market valuation was about a year ago. So this is about mid-July a year ago. Where are we at? So, and everyone knows I love this slide because I think it's very informative. So the middle dotted line here that I'm mousing over is the last 25-year average of the S&P 500 forward PE ratio. Forward PE ratio means what is the price to earnings ratio based upon the next 12 months of expected earnings that are going to be kicked off by all the companies in the S&P 500, right? So this is the 25-year average, which basically is around 17 times, meaning if I want to buy the S&P 500, I'm pretty much paying 17 times for every dollar of earnings that the companies in the S&P 500 kick off. So and then when we look at the standard deviation around that, the low range, meaning 66% of the time, the PE ratio falls within these two dotted lines, right? And so, when you get below a 13.5 level PE, that should be a pretty strong buy signal. That means things are usually pretty cheap based upon the long run average. But when you get above 20, which is the upper band, that's when things are kind of expensive and maybe you got to be a little cautious. So we were actually below average a year ago, which means things aren't, not a bad buying opportunity. And so where are we today? Well, now, remember we were here a year ago and here we are today. We are now closing in on that upper bound. The 12-month forward PE ratio of the market is right around 20, which is kind of getting into more expensive territory. Now, was it higher in the past? Absolutely. It was higher during the pandemic when we had the tech boom during COVID. And it was also a lot higher during the dot-com bubble, or I should say before the dot-com bubble burst back in 1999 and 2000. So it certainly is possible for this line to continue to move upwards. But the point is that almost on any metric you look at when you're looking at the market in terms of determining, is it really expensive right now or not? The answer is, yeah, it's on the expensive side. It's certainly well above average. And if it starts to go above this upper band here of like a 20-ish PE ratio, that's when I think it's time to get, perhaps a little extra cautious. So that's where we stand in terms of market valuation. And so what does that mean? What are we really going to pay attention to moving forward? What do we need to think about and potentially be worried about? Well, first of all, the market right now seems to think that the Federal Reserve is going to actually raise rates one more time this month. And that should be, actually, I believe the meeting is next week. And they think it's only going to be a 0.25% rise. And then they think the Fed is going to be done. The Fed is going to step back and say, you know what? We've raised rates enough. We think inflation is on its way down. We're just going to keep it here for a while and see what happens. The market is assigning a 90% probability that that scenario plays out. Do I think that's accurate? Yeah, I think that's probably true. I do think the Fed will probably raise one more time. And some people actually think they don't need to raise again at all. And I think one of the reasons why I think the Fed still thinks they need to raise again is because I still think they know they have an unemployment problem, meaning unemployment is still stubbornly low. And as long as that remains the case, inflation still could be an issue. So they don't think that inflation, we're out of the woods yet. So I do think they're going to raise one more time, 0.25%, and then hopefully they'll be done. And then the question is, what happens after that? So that's going to be something to keep an eye on. So I talked about the inflation dynamic and the employment dynamic. I do think, a lot of interesting things are happening with the Russia-Ukraine war. And, obviously, Russian stability is a question mark. I do think it's kind of perhaps underestimated what I would call a humiliation Vladimir Putin suffered recently as a result of the dynamics of the Wagner group and all that. But that doesn't mean that, if the Russia regime runs into a lot of trouble, that's going to be good to markets. Sometimes instability like that can be bad. So, we'll see we'll have to keep an eye on that. And then I mentioned, dollar has been weakening. Will that continue? Because if it does, that's usually a good sign for international stocks more so than domestic stocks. And then, of course, there's the economy. Everyone talked about us having a recession this year. They talked about that last year. Well, that didn't happen. And that doesn't look like it's going to happen. We've actually had positive gross domestic product growth now for a couple of quarters in a row. Everyone kind of expects that to continue. But they do expect GDP to slow down. The question is how slow. And the analogy is, when you have an economy where the GDP is kind of really slow or slowing down, it's kind of like riding a bicycle at a really slow rate. When you have a really slow moving economy, sometimes it's easy just to knock that bike over because you don't have forward momentum. And so that could be the fear. And that's one of the fears, that we will fall into recession at some point in 2024. China, China's economy is actually not done as well as people thought coming out of the pandemic and the lockdowns they had. And that kind of matters, right? Because China's, a big engine of growth for the overall global economy. And they're a big consumer of a lot of stuff in the global economy. So I'll give you an example. Even though China, they represent about a total of 18% of global GDP, which is the second largest, but they actually consume 60% of the world's copper supply. So that's what I mean by, like, China dynamics matter, because, if China slows down, then it has a big impact on all sorts of things, like the commodities markets, and that has knock-on effects. So that's why, what happens with China matters to the global economy. And of course, the big question is, and I certainly hope this is the case, let's hope that the first half, which we all enjoyed some great gains from the markets in the first half, I'd really like to see those us hold on to them. So even if the markets kind of grind around and do nothing for the next 2 quarters, that's okay. I think we'll still look at 2023 as a pretty good year. So then real quick, what does it mean we're doing for the portfolios? Well, as mentioned, I do think that those top tech stocks, those top names that have driven the market, the narrow group of stocks, I think they've gotten ahead of themselves. And even if they haven't, they're certainly expensive. So it's certainly not a time to double down on them. If anything, I think we need to take a little bit off the table. Thank you very much, you 10 awesome stocks that delivered most of the returns. We're going to reallocate a little bit to some of the stocks that didn't enjoy those returns. And that's exactly what we're going to shift a little bit of the portfolios towards. In terms of bonds, I kind of was talking about this with the yield curve. I do think it makes sense to actually start enjoying some of the higher mid-range yields, that 4%, 5%, 6% yield zone, because eventually those short-term rates are going to come down. So if we're only in short-term bonds and they come down, when we have to reinvest the money that matures, we're not going to have many attractive options left if the yield curve has normalized. So that's one of the reasons why we want to take advantage more of that middle spot of the yield curve. And we are actually raising cash and cash equivalents. So what does that mean? It means actually that's one way to get a little bit more conservative. It gives everyone a little bit more what I'll call dry powder, meaning that if we do have a pullback, or those tech stocks correct, or we run into a little more trouble than people seem to be anticipating, it means we have the ability to then to move out of cash and back into the markets if things get a little more reasonable and less expensive. And by the way, the cash is not going to be idle. We are going to leverage a money market fund for the cash. And what is a money market fund? Well, it's basically a very, very short-term investment that has a pretty decent yield, similar to very, very short-term treasury bills, which would be anywhere in the vicinity of 4.5% or 4% or so. So that means that the cash will actually be earning a halfway decent return. So unlike 2 years ago, if we were in cash, the return would have been pretty much nothing. So that's why we're very comfortable allocating a bit more to cash equivalents, because at least you're actually getting a halfway decent return on that while we ride out potentially what we might see as a bit of a choppy second half of the year. So as always, I spoke a mile a minute. We hit about the 45-minute mark. Now I want to move on to question and answers. I know we did get some questions sent in advance. I'll try and address those quickly. But Katie, is there anything I should be aware of in terms of questions that came in?
Yes. So we did get a couple questions. One specifically from an attendee asked, what industries do you see being negatively impacted or affected by AI? And, in terms that'll put more people into unemployment.
Right. So, and that's a question from Frank. Thank you, Frank. I think part of that was what I was talking about in terms of the effects of various industries that AI is going to have. I think the bottom line is AI potentially can help every industry. It's really a question of how many people is it going to displace in various industries. And I think the short answer to that is the industries that used to be really attractive because it required people to be very smart and have a lot of brain power and do a lot of higher order level thinking. Those types of jobs, I think, are going to be more under threat, because that is exactly what AI is getting really good at doing. And so I'll give you a good example. A friend of mine who's one of really excellent top lawyer at a firm. One of his specialties is negotiating distressed debt arrangements. And, he was saying that by all means, he's already seeing AI replacing a lot of what he would consider to be white collar workers in his firm who used to pour through documents looking for things, and AI can do it a lot quicker. But he said, in terms of what I do, in terms of advocating or negotiating the position and leveraging the nuances of previous cases that I'm aware of and how they played out, and using personality to convince people across the table to look at my point of view, AI is nowhere near to being able to do that, right? So those are the kind of dynamics that we're going to see playing out in terms of AI. I did see some questions come in on commodities like gold and silver, precious metals. What should we do in regards to that exposure? And my short answer to that is, gold is always looked at as sort of a hedge to either bad markets or inflation. The problem is, if you actually own physical gold, it's kind of like owning a rock. It doesn't really return anything. You just got to hope that the rock's price goes up. Whereas, usually if we do invest in precious metals or commodities, we tend to usually do it through, like, I would say, like a miner who mines gold, but actually is a physical company that actually pays a dividend. So that even if, gold prices go nowhere or the stock goes nowhere, you're actually earning something on the company that is doing precious metal mining per se. So, any other things I need to be aware of in terms of questions, Katie?
Yeah, one more interesting question actually just came in, and it is, are you using AI in selection of portfolio and evaluation of individual issues? So that's interesting, like can it analyze stocks, I guess, and things like that?
Oh yeah, that's a great question. In other words, are we using AI ourselves? The short answer is yes. And how are we using AI? Well, for example, as a starting point, if let's say there's a particular stock or a fund that I have my eye on because I'm looking at its performance or I've read something about it, I can actually leverage AI and type in multiple queries about that particular stock and usually get some pretty interesting information that normally would have taken me, I don't know, a couple of hours to research myself. But now I can get some key information within seconds, which then allows me to do even more important research on whether or not I really want to use that investment for various portfolios or clients. So we already are leveraging AI. I do think that's only going to increase. And I think part of the race that's on is not just individuals kind of leveraging search engines and chatbots, but also how an organization overall can systemically embed AI into what they do to make their operations run more efficiently and capture more value that way. So it's happening. And again, that's why it's really important to stay abreast of these trends, because I really don't think you want to be behind. It's kind of like when the PC revolution happened back in the 80s. Now if you go into an office or most typical jobs, if you actually aren't using a personal computer, it's kind of like you feel like, how can I even function, right? But back then, having a computer on your desk was kind of a novel idea. And right now, I think actually using ChatGPT for a lot of your queries is still somewhat of a novel idea, but I think that's changing super fast.
Great. All right, and last question that came in, and then we'll wrap it up, was that Meta looks like it has a low PE compared to the other tech stocks. Why do you think that is?
Oh, all right. Well, let's go back to that chart. Sorry, I'm scrolling like mad here.
No.
Let's look at Meta. Well, 28.5. You're right. That's low relative to some of these other ones on here, like Amazon and Tesla in particular. Still expensive though, and you could argue that, as I was saying, once you get into the high 20s in terms of forward PE, that's pretty expensive relative to the overall market. So the real question is, first of all, is that a justifiable PE for Meta? Two things can happen. Either Meta's earnings can be a lot better in the future, and what that means is that ratio would go down, because then the price of the stock, if the earnings go up, then the PE ratio is going to go down, which a lot of people are anticipating, because why else would you pay a super high PE today? It's because you expect those earnings to actually do better than expected. The other thing that can happen is the price can come down. So if the earnings don't really change, but the price comes down, then that PE is going to come down also. So, you know, one of the reasons why Meta is at least according to some of these other stocks, to answer your question, why it might look a little cheaper versus some of the other AI related stocks, is because Meta is still investing a ton of money in some things that people aren't really sure of what the return is going to be, which makes its future earnings questionable. Meaning Meta has, you know, spoken a lot, and why they changed their name, they believe that the metaverse in the future is going to become incredibly important. And so they've invested all this money into developing a metaverse and equipment and tools like the Oculus to navigate the metaverse, play in the metaverse, negotiate in the metaverse, build alternative realities. Some people are wondering, like, how much are they going to monetize all that investment that they're making in that? And the answer is hard to know. But Meta still makes a ton of money from their pride and joy, which is Instagram and Facebook. Still getting great ad revenue from there. And one of the reasons why Meta is enjoying a higher PE ratio than the market right now is because they are able to use AI to make their ad search functionality and the ad result functionality more powerful for the people who are paying them to put the ads on Facebook or Instagram. So that's a perfect example of how AI is actually making a company's existing product better. Meta is basically representing that we're integrating AI into our advertising platforms, and you, client, who's paying us for that advertising, are going to get better results because of that. At least that's the story Meta is telling. Hopefully that plays out if you're a Meta believer, but you know, we're still seeing whether that really works.
Yeah, that makes sense. Okay, great. If no one else has any other questions, and Steve, I think that was everything we wanted to touch on. We can go ahead and close out.
Well, I do want to thank all of you for spending, hopefully, a quality lunchtime with us, and hopefully you enjoyed your sushi or meatball parm or wherever it might have been. And again, if anyone has any specific questions that weren't addressed, feel free to let us know. And of course, we all look forward to working with all of you one-on-one with your specific retirement needs and estate planning needs and all those other good things. That's what we're here for. So with that, thanks again.
Thanks, everyone. Have a nice rest of your day. Bye-bye.